Um, Professor Victor, distinguished guests, colleagues, thank you for that rather, let's say, interesting introduction. I took a few points. I was writing down some of the things that you said, and I want to confirm that I'm very interested in marathons, very interested in marathons. And recently you had one of our key marathon runners. I think he's, well, by all standards, he's the best marathoner ever, you know. And his name is Eliud Kipchoge. And he's a friend. And just last night, before going to bed, I tweeted about him. And this morning, one of the first things I did was to check my tweet, how many people have actually forwarded it and things like that. Now, unlike ourselves, we just are on the sidelines. He obviously is trying to do something that's remarkable, which is to break the 2-hour limit. So he's doing the 1 hour 59. And anyway, so we've been talking with him about it. Very exciting, very, very exciting. So yeah, that's true. I do like marathons. The other things that Victor, you mentioned, Professor, you mentioned, and I would also declare that it's true we did this project with him and others, that is around the 50th anniversary of the central bank. And I noticed that when he was inviting me, well, maybe I should say that as happens, there's a product that needs to be, there's a book that we are publishing, as he said, and I have to tell you that I am the one who's holding the book back because I have a delayed submission of a chapter. You know, does that sound something that you're familiar with, you know? And so I noticed that over the last few months when he was encouraging me to come to this event, he never mentioned that delayed chapter. I'm pretty sure once I'm done, that will be the topic for conversation, and I'll get warnings and things. But so far, Victor, you've been very well behaved. Thank you very much. But the discussion here, frankly, I'm delighted to be here because to deliver this keynote address and to such a distinguished audience, really to exchange ideas about FinTech. As the Baroness said a moment ago, this is an important element of what is being done at SOAS and indeed in the wider community of researchers, trying to understand better, trying to see what works, what hasn't worked, and answering some key questions which we would benefit from, we as policymakers and so forth. So thank you for inviting me. And also thank you for coming. You and your colleagues came for the FinTech Festival that you mentioned. We had some 2,000 participants from around the world, 50 countries. And this was bringing together people that are interested in FinTech, seeking to take advantages of the opportunities presented by technologies in fulfilling financial needs. So as you know, advances in technology have increasingly transformed our society and indeed the economies around the world. And over the last, let's say, dozen years, in my own counting, really this whole business begins around 2006, but we could actually just say, okay, this century, you know. So I think we do distinguish people in two ways. One, those that let's say the millennials and non-millennials. So here I don't know how we're going to do it. We are probably going to say millennials, right? So we are on this side of this millennium. But anyway, so 2006 maybe is the where we could say ground zero or T equals to 0. But one could be a bit more generous than that. But we've witnessed a lot of significant increase of mobile phone-based innovations that are transforming our financial systems. Add to that the impact of globalization and the prospect of the prospects that are before us are nothing short of revolutionary, because they are revealing new tools for achieving inclusive economic growth, sustainable development, and obviously poverty reduction. Now, this conference provides another excellent occasion to share our experiences so far, examine the opportunities that lie ahead, and the challenges in embracing innovations and disruptive financial technologies as tools for financial inclusion. But importantly, this conference, as the Baroness said, needs to identify, or we participating in this conference, we do need to identify the areas for further research, and there are many. The number of questions that we as practitioners or policymakers have, and we have to sort of, let's say, shoot from the hip, because we have no clue about the precise answers. There are many of those, and I do look forward to seeing more and more papers in this area, because there are significant questions that do deserve proper treatment and proper answers. So first, I want to have what you may call sort of a tour of the horizon, setting the landscape, the problem, and the opportunities. So financial services are key elements in dealing with poverty, inequalities, and related economic and social issues. Interestingly, the World Bank popularized financial inclusion as correlated to poverty reduction. It's amazing, the word was correlated. And in the absence of efficient and safe channels for financial transactions, many households cannot manage their risks nor diversify their asset holdings. Also, the micro and small and medium-sized enterprises cannot access finances which would create employment opportunities, and at a macro level would promote growth and reduce inequalities. More recent research has confirmed the connection between financial inclusion and inclusive growth. Inhibitors such as distance to formal financial services, the service points, high cost of financial services, lack of suitable products, and even cultural practices that impede access to financial services, particularly for women, have all been identified. The puzzle then is, if these connections were so evident, why did we have to wait this long? That is, only over the last 15 years has financial inclusion around the world risen significantly. What is it that is different last century and this century? And why is it? Once we know what the catalysts were, maybe we can push harder to facilitate a complete reduction, or rather virtual elimination of financial exclusion, as the World Bank has set as a target for us in the world. So that's really the question. What disrupted this, what you may call, unwelcome equilibrium? Now, several factors converged and made possible the increase in financial inclusion over the last 2 decades. The wide adoption of mobile phone technologies, financial innovations primarily related to digital devices, innovative regulators, and in the case of Kenya, expansion of agency banking. I think the word you'll come across again and again is M-Pesa. Now, the pronunciation depends on who you are. When I went back home after 20 years at the IMF, I would call it something else, M-Pesa, the M. And one fine day, it's not M-Pesa, it's M-Pesa. Well, fine, so much for that. But I think this is a product that everybody around the world has come to understand, that it has been truly revolutionary in the case of Kenya, and I'll talk a little more about it. But I need to stress that it wasn't a one-man show, meaning or one let's say, only one factor contributed to this. I want to insist it was a convergence. It was sort of yeah, there was a convergence of positive factors. So you may want to say that there was a perfect storm of that was brought together, let's say, due to many positive factors. By the way, in particular, I just mentioned now innovative regulators. That includes the central bank. We can talk more about that. But I think it's also important to mention that there were other innovators, meaning people that took the risk. And in this particular, I mean, at this point, I would want to single out DFID. There's a representative for DFID here, but the point is they put in £1 million. I think that's the number, maybe a little less if you eliminate taxes and things like that. I don't know what else you eliminate, but he can give us the numbers. But it was £1 million, and that actually, in my view, if you look at the output or the return of that £1 million, those £1 million, I think it has probably been phenomenal, not only in terms of financial returns, if they were doing that, but also in terms of social returns. Social returns were huge, and I'll explain that in a minute. Now, leveraging on digital financial services, access to financial services in Kenya has more than tripled from 26% in 2006 to 82% 2019. We measured it in January, February this year. More importantly, mobile phone financial services have lifted thousands of Kenyans out of poverty and enhanced their livelihoods. In 2016, for instance, research by Tavneet Suri and others showed that mobile phone-based services or mobile money services, and it was really for the most part M-Pesa at that point, had increased daily per capita consumption of 2% of Kenyan households and lifted them out of poverty. Just think of that, 2%, just one little product. I think if you think of an NGO that is working with, I don't know, whatever it is, some social function, I think their targets are hardly 2% of the population that will be lifted out of poverty. And this product allowed that to happen. Since then, I'm sure the impact has snowballed, and the impact actually is much larger than this. So that is important to mention. And also, the researchers showed that they demonstrated the long-term positive effects on poverty reduction, especially for women. And they were looking at women-led households, and this was significant, and I think it will be even more significant in places where, let's say, women are less connected to the economic sort of channels, so are less connected to the formal economic channels. And unlike Kenya, there is a lot of that, but I think if you go to other countries where this is not the case, then I think the impact will be much more. I want to mention just one thing about the innovativeness of the regulators. We could come back to this, but I have to tell you that when the product M-Pesa was brought to the central bank, I think that was a positive step by the innovator. They said, we have this widget, whatever it is, we can do this, we can do that. I think the story around that needs to be told. Because first and foremost, the courage of bringing a product to the central bank. And they felt that it's good to have the regulator deal with it. And it wasn't clear who the regulator was. There were no laws that actually dealt with this product. The central bank also, this is the part that they were innovative, they did not toss out this widget and sort of say, you know, we are not, I mean, we look at we do bank supervision. This is not a bank. This is not our problem. You know, take it out of the building in case it explodes or something, yeah? No, they actually had that conversation with them. And in a sense, began to see what could be the potential benefit? The benefits actually were much smaller. I've gone again and looked at the reports that were written at the time, and they weren't looking at 2% of population or any of these things. No, 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 no. The numbers were in the thousands. They weren't really significant. And it was really just a money transfer system that would be more efficient, and also more secure. That was really the only thing. Instead of walking around, people who are working in the cities sending money back home, that process was kind of dangerous. That is one thing. But the other thing is that it should also be known that the central bank, once they began looking at it, they identified whatever risks that this product posed to the financial system. And they worked with the company Safaricom, well, later became Safaricom, but I think worked with the company or the innovator, the private sector innovator, to reduce or to minimize those risks, to deal with those risks. I think that is important to have. Nowadays, we do get a flood of these fintechs, and all of them think that they have a finished product, right? And frankly, from my assessment, it's no better than, say, a class project. And they have to bring it from a class project type to, let's say, a prototype, and that is a long journey. It involves a lot of proof of concept. It involves a sort of a beta product, and eventually you could have a sort of a product that you can say is ready for market. And that journey requires hard work, no different from the work that you and I do, but it is hard work, and it has to be done. So I just wanted to explain the innovativeness or some elements of the innovativeness of the private sector innovator. It wasn't just, I have a product. It was also how the product is prepared to be ready for market, and also the innovativeness of the regulator, who actually at that point, there were no rules, there were no laws, and was willing to let, after we had minimized the risk, was willing to allow this product to be connected to the financial system in a pilot, and with the understanding that if anything went down, anything came up that was problematic, it would be pulled off the grid, meaning just turned off. And that was the situation. Of course, the product improved. There was a lot of acceptance and use and so forth. And the laws didn't get put in place until 2012, much later, many years after. So in that period, you could say there were no laws that were being followed, if you understand what I'm getting at. And that is what frightens a lot of us. And in this case, we are happy that the central bank was willing to accept that risk and run with it. And eventually, as happened, the laws were then set in a particular. Remember, you couldn't copy somebody's law. Now everybody's copying everyone's law, right? Mexico actually started off by looking around and figuring out who has what law, and now they have a proper law, FinTech law and things like that. They even have a nice, shiny sandbox section. But things were not as easy and crystal clear as they are today. Okay, so today, our fintechs have taken over many customers, or many customer interfaces, owing to their flexible culture, while incumbent financial institutions are leveraging on their expanding financial intelligence, experience, and scale. I must note, however, that technology-driven financial inclusion is not just a Kenyan story, but an African one as well. Other African countries have also seen transformation in financial inclusion, leveraging on mobile phone technologies. From Rwanda and Tanzania in East Africa to Nigeria in West Africa, and all across the African continent, mobile phone financial services are transforming the lives of citizens. The success that Kenya and similar countries have achieved in fintech space is attributed in part to the unprecedented increase in connectivity and the proliferation in the use of smartphones driven by low-cost devices and low-cost data plans. Africa has one of the fastest growing mobile phone adoption and penetration rates globally. For instance, in Kenya, the mobile phone penetration rate is as high as 105%. So it means that a lot of us have two devices, or some of us have two devices. Now I only have one. It's bad enough having one, you know. So, but actually my aunt has two. And I remember when I had this is interesting. The people actually are very aware of this. My aunt has two of these devices, and they're on two different networks. And I asked her, why do you have two? It's complicated, isn't it? And she said, no, 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 no. She explained it to me. Basically, she knew the tariff rates of both companies, right? And she would use one when it was more opportune to use that phone. I mean, that phone, you know, that service provider, and use the other when it was more opportune for that. So here's somebody who was very good, and she's like 90 plus years, and she understood arbitrage better than me. So it's amazing when you get to that, and anyway. But I think there's also something else, as an example, which I think will resonate with some of you. At times we think that the benefits are in the directions that we mentioned, right? Just efficiency. So you want to send money to somebody, and it's more efficient, it's secure. So the sort of efficiency gains. This is a standard economic sort of argument that we could all put forward. But you know, it's not just that. The innovativeness of others down the chain is phenomenal. And that is what I think that's what this whole process has opened my eyes to. So in a sense, the second order effects are significant. I'll give you an example instead of giving you numbers. We were looking at some of our data in one of the biggest lending platforms that we have. This is now maybe 2-3 years ago. And it turns out that we saw some odd patterns in it. It turns out that about a third of the loans, this platform, lending platform, it is sort of for small loans, micro lending, and it is on the mobile phone and so forth. It's probably one of the most, anyway. So we were trying to understand it. We found out that about a third of the loans are disbursed between 3 and 5 a.m. in the morning. 3 and 5 a.m. What's going on? Obviously, this is not something that. So, okay, what is society? You know, so everybody has their, obviously, hypothesis as to what is happening. But then you also discover that more than a half, or about a half of them are women. So wait a second. Half of them are women. I mean, you'd expect that they are much more. So issues about, you know, that's when people are living, I don't know, they're social sort of places late into the night going back home, so they're making payments for their beverages and things, you know, those sort of things. Well, those obviously go out the window. Anyway, so we asked some people to look at this, and they came back with the following story. This is now how it works. So apparently, our markets, our agricultural markets, they are the wholesale markets. They're actually very active at that time. They begin operations around midnight, and by 5 o'clock they are done. So that's when they're really active. So we discovered that what happens is you have, let's say this lady, this is the fruits, the lady who sells vegetables on the street. So she wakes up around that time. She then calls her wholesaler, her contact, on the phone. She hasn't left the house. So she calls the wholesaler. She knows him or her, and then asks for, I don't know, a sack of vegetables, whatever it is, and pays by phone, right there. So that's your activity. Pays by phone, and then she will call the person with the hand cut and sort of tell that person, this yet another person, this is a human contact, calls him and says, it's always a him, calls him and says, I have this sack with so-and-so, could you go pick it up and leave it and bring it to my stall, you know, whatever, this intersection. She'll then pay him. Then she'll wake up her kids. This is now maybe like 5 o'clock, wake up her kids, send them to school, and around 6:30, she'll go to her stall, to begin her day. The vegetables are there. She's got the best because she bought it at the right time. And the governor of the central bank hasn't even made it to his office at that time. This woman has been transacting the whole day before I'm even out of bed. So it's interesting that that could not have been possible, and you can see the benefits of this. That could not have been possible without the mobile-based sort of transaction and really the transformation that the mobile service or mobile-based financial services have allowed. There are many other things that we have seen, many interesting questions, but let's just say that that data is dying for some rigorous assessment and study, and I hope that some of you will take up that challenge. Now, what's the promise of FinTech? FinTech has proved to have this capacity to meet the objectives of financial inclusion, that is access and efficiency, over the years. And in this pursuit, the FinTech industry has evolved tremendously in emerging markets. It is no longer made up of just startups. FinTechs today constitute a host of seasoned companies that offer a broad array of financial services and operate on a global stage. FinTech has taken center stage as a central part of our lives, and as a result, the economy is becoming increasingly digital and, of course, data-driven. Just like with the genesis of FinTech in Kenya, it is mobile technology that pivoted the FinTech revolution, and in many emerging economies, FinTech revolution in many emerging economies across the world. The subsequent wave of innovations witnessed in payments, banking, investment, clearing and settlement, offering both the banked and unbanked cheaper and faster services, and powering e-commerce have further exemplified the promise of FinTech. To highlight Kenya as an example, the Kenyan FinTech ecosystem has evolved tremendously from a money transfer service rolled out in 2007, that's M-Pesa, to a robust integrated FinTech ecosystem now in 2019. And this is why I told some of you, I was talking to a moment ago in the VIP room, I hope this wasn't a bomb. When I say that I'm a bit tired of being told about FinTech, about M-Pesa. M-Pesa this, M-Pesa that, because there are many other products that maybe are even more exciting. And we need to look at all the other products because it is important if we want to address the issue of growth and equitable equity in our economies. So for instance, so this is the various services that we have in the Kenyan ecosystem. There are others, but we want to mention this. First, transforming we have transformed an integrated payment and banking ecosystem with a robust credit and savings platform with several commercial and microfinance banks. And they have rolled out such platforms such as M-Shwari. You've heard of M-Shwari, maybe not, but if you haven't, then this is the time to begin working on that. And we've talked, of course, about M-Pesa, but there's also, M-Pesa is working closely with other banks like KCB Bank, where they are they call it KCB M-Pesa, which is really providing micro loans to various borrowers. We've also had the same with Equity, which is the Equitel platform that is also providing simple banking loans, but at small micro banking loans. We have also seen the leveraging of these money platforms to mobilize funds for government treasury bonds, like M-Pesa, like Emakiba. Emakiba is a platform where you can buy government securities for as little as $30. Just think of that, 30 US dollars. Now, if you and I want to buy government securities, T-bills, T-bonds, maybe you go down the street and there's some investment advisor, or for that matter, you could go to a commercial bank or whatever else it is. But I'm sure they're not going to say 30 US dollars. I mean, the equivalent of that. They'll laugh you out of the place. The time of that person you're going to talk to is much more valuable than that. They'll be talking, so sir, what do you have? You know, are you thinking 100,000 or, you know, whatever it is? Though at that point, they won't say 100,000. They'll be saying, you know, do you want 100? You know, and you know they've dropped 3 digits, you know, or whatever it is. So for as little as 30 US dollars, but let's think about this. Who are the people we are targeting? Surprise, surprise, we are targeting the Caspers, people who earn as much as, up to, let's say, in a minimum way, 5 US dollars per day. 5 US dollars per day. Just think of that. I mean, those are people, you're not even talking middle class. I mean, you're talking middle class and even upper low income class. You know, think of the guy who is perhaps, the woman I talked about. She's earning a little more than 5 US dollars per day in that sort of operation. So she can save 1 US dollar every day. I'm sorry I'm talking in US dollar terms, but I'm sorry the exchange rate of the pound is moving every day. So I don't know. For reasons that are beyond me. So we just, anyway, whatever the exchange rate, you multiply it. So 1 US dollar per day, if she can save 1 US dollar per day, then at the end of the month, she has 30 US dollars. And that is what she can put into this product, meaning government securities. You can't get better than government securities in terms of savings. So you have a new savings product for people in that income bracket, that demographic. And this is not just removing money from the mattresses and things like that. It's really a vehicle that was not there before. So what is the point? The point is we are transforming the savings habits of Kenyans through this product. That's the point. And hence, it is transformational. At the end of the day, our job is not, we talk a lot as economists about deepening capital markets and things like that. And I'm sorry, I did hear a lot of that in our previous life. You know, this is the economics 300 and things like that, you know, writing a paper about all those things and more efficient. The point is that here is a case of a product that will definitely transform the financial services or democratize financial services as we know them today. That is the objective. And if we can do that, you can then wax poetic about inclusive growth, you can wax poetic about inequities or making things more equitable, just with products like this. Now, I can tell you, it's sort of behind the scenes, it has not been easy, because it's a good idea. But implementing that very simple idea is the challenge. And let me give you one of the challenges. I'm sorry, I get very excited about these products. One of the challenges is that woman that I talked about. You know, so she saves into this thing. And then suddenly, she needs the money in the middle of the night because her child is sick or whatever else it is. Or somebody comes and there's somebody, whatever. That's the typical life of people in that region because they have no buffers, right? They have no buffers. Everything that they have is assigned to some particular expense. So she cannot say, well, my money is in these government securities. So she has to somehow deal with it. So the innovation was actually to have a sort of a way, a mechanism where she can liquidate her savings, obviously without a loss, you know, without taking a hit. She can liquidate in the middle of the night. And let's put it this way, we were able to do that. So you and I, when you buy your 100,000 of stocks or securities, if you want to liquidate them, you'll have to wait until the next morning. I mean, you'll send your message to your broker, and you'll get an out-of-office return, and the next morning he'll deal with you, right? But you have other buffers. You have more liquidity in other places. You probably have money in your credit card and things like that. So you can deal with those things. But these people at that level probably don't have that. And so the innovation wasn't just the thinking of the product. It was actually figuring out how to deal with that problem and putting a solution that is actually appropriate. Okay, so we have all that. So from our perspective, the full potential of FinTech has not yet been realized. So we have the rails, as it were. Now we have to put on the wagons, and that's the issue. So we have now the infrastructure. So the wagons will be all what really the innovators can bring. If it fits not just within the wagons, within the rails, but also in the sense of the vision of that we have for FinTech. So the emergence of mobile telephony, the ubiquity of the internet, availability of high-speed computing, big data, and machine learning could all combine to enable rapid changes in finance, just as they are doing in other areas of the economy. The emerging areas of innovation that FinTech can explore include the following. First, the whole issue of big data. The large amounts of customer information from the growing digital footprint means that FinTechs can leverage alternative data sources to build customized business models to open new markets. Whoever drafted my speech here had a love for words, but I'll deal with that when I go back. It could have been simpler. And I'll probably put out an example for you, which is we are trying to provide financing to the SMEs. And there are photos of me in the markets in Kenya talking to various SME people in the SME sector. And we have brought out, and very soon we are going to launch a product known as Stawi. This product allows, through this product, it's actually an interesting product. And again, maybe I shouldn't apologize, but I get very excited about some of the products that we are putting out because they are transformative. And this product is also transformative. We've been unable to provide funding to SMEs. The typical answer is they're too risky, very risky. I mean, this is your standard thing. What do you mean by that, too risky? So in any event, we have 5 banks that have come together. Mind you, that is a first. Banks are supposed to be competitive, meaning they'll tear each other and rip each other as they strive for, the sector. They strive for a greater portion of the financial sector and so forth. So 5 banks have come together, and using information that is in front of them, big data, and really this is exchange, or should we say transactions, that SMEs, every single person in Kenya, as I say, has, well, not every single, virtually everybody uses this M-Pesa and M-Pesa-like products for transactions. I have famously said that I have never I've set foot in banks. The last week I ended up walking into a bank, not for my own transactions, but to meet some customers. But for my own transactions, I've never been in a bank. And I have no interest in going to a bank because I can do all my work I can do all my transactions on my phone. And a week ago, I was in Garissa, one of the remote places, border with Somalia. So you can imagine how hard that place is and very dry. They are pastoralists. And I was talking to them. We had to talk to them for various reasons. And they said, no, our bank is M-Pesa. And these are people who actually go out there and, for 2 weeks, they are wandering with the animals, and they'll, go for months looking for pasture and things like that. But they know with their phone. All they need to do is to get near a road, because you have all the telephone towers near the main roads. So once they get within striking distance of that, they are okay. Now, they'll only turn on the phone when they are close to the phone, to the road. So the issue of running out of power and all that is not such a big issue. I mean, of course, it's a problem, but it's not such a big issue. They know when to use it. And so when they sell their cows, part of it is paid on the phone. There's still a lot of cash floating around. And the reason I was there is because we are talking about demonetization. So we are withdrawing some of the large banknotes. And so it is important to talk to the pastoralists who maybe for a month they're out there without any contact with the rest of civilization. So, but anyway, the point I'm making is that with data that is available from your transaction, on your phone transactions, they are able to determine your credit risk and can actually, let's say, score you correctly, and they can actually, the accuracy of this, now I'm not sure where the type 1 and type 2 errors come to, but anyway, those are for the econometricians with us. So they can score they can score you with 98% accuracy, 98%. Now, a credit officer, if they're really doing a good job, they are lucky to be within, let's say, 70 to 80% accuracy. I mean, it's amazing. So actually, the first job that will be taken over by these things is the credit officers. They'll be jobless, which is just as well. You know, I've never understood what credit officers really know about me. I mean, they claim that they know something about me, but they don't. Because the questions they ask me is, how much do you earn? I mean, that's kind of boring, right? And frankly, I'm just making the point that this product is using big data. And when I say big data, it's not just the transactions. Apparently, and this is a major secret for all of you, they look at your contacts. And if you are like some of us who have their contacts, you know, so I don't have Victor's name, you know, in there it is Vic, V-I-C, right? And, you know, whatever, you have all these nicknames and things like that. Apparently, they've discovered that those sort of people are less organized and are therefore more risky. It's amazing. So Victor, if you want to get a loan, please organize your contacts and have, you know, Governor Patrick Njoroge, you know, and all that. Then you'll be less risky. But I think the point I'm making here is that they are not just using the transaction data. It is everything about you, which is much more important than just asking about my salary. Because the SME doesn't, I mean, the operator doesn't have a salary, you know, so there's a lot more. Now, there is also a problem with that sort of operation, but I'll leave the problems for later, our discussions at a later point. The other thing which is also important is the use of digital identities for identification, and then to reduce this reliance on traditional paper-based or plastic-based identities. I think there are risks here. But I think India has done remarkably well, as you know, with the UDI, I think that's what they call it. But I think the point here is there are multiple ways of doing this issue or dealing with the issue of identity. And the only thing that matters in the end, it is me. That's all that matters in the end. It's not that I should be, the fact that I'm Kenyan or I'm here today, all those are somewhat irrelevant. I'm the same person, and somehow you need to tie me with my history, whatever it is. And I think the technologies that are coming through FinTech can do this quite well. There are questions about cross-border remittances. I'm not going to talk too much about that. And I've already talked to you about this smallholder finance. But I think it can be expanded dramatically. A big issue that we have been having is with the farmers, agricultural financing. And I remember this right from my undergraduate days. This has always been an issue. But I think the solution can be dealt with. The solution can be a fintech product can actually help resolve this much better. Last point, which I rather talk to it, is, there's the label of fintech. So you get a product and you call it a fintech product. And you expect that everybody will be so excited about it like you do. And that is a problem in my view, because it's not the label that does the job. Maybe if you're looking for funding, if you say, okay, I have a fintech product, then you'll get funding, as opposed to saying, I'm investing in, I don't know, some venture capital somewhere. But I think the point for us is fintech, if you're in the fintech space, or any space for that matter, but fintech in particular, the question is, what problem are you solving? Think about that. It's not, I gave you a list of problems or solutions, but really the first question should be, what problem are you solving? And if you have clarity about the problem, then the solution can follow. But it's not when these guys come to us, the fintech innovators, that's the first question we ask them. So yeah, you have a nice shiny widget, but what problem are you solving? And quite often that lack of clarity is where the problem is, meaning they don't know what the problem is out there. And yes, they believe that their product will be, my famous question, we had these people coming to us, and I hope they're not in this room, talking to us about bitcoins that should be resolved with, bitcoins in Kenya. You're talking what? We have problems with our water. We have, and now you're telling me Bitcoin? So what, think of a school teacher. What problem does she face that will be resolved by Bitcoin? And so that discussion didn't go well. Let's just put it that way. I also had a discussion with, we are among friends. I had a discussion with Facebook. Kenya is if you can do it in Kenya, you can do it anywhere in fintech space. That's the way they think of it, which is true. So they came to us, and we were talking about their new product, Libra. And we had to push them through the same system. We had our fintech team deal with them, ask those same questions. So what problem are you resolving? It's all very nice to tell us it works like this, and you have weights of these currencies, and then you spend a lot of time arguing, should it be the SDR, should it be this? But the fundamental question is, what problem are you resolving? It turns out that the problem they are trying to resolve is reducing the cost of remittances. So, well, okay. So if that is the question, we have 1,000 other ways that we are working on to reduce the cost of. So why is US the most efficient? Or are we just having a label, having a product that we then just put out there and, whatever other things that will follow? So this is critical. Please always ask that question when people talk to you about fintech products. Okay, so I guess the others have moved rather quickly. I'm sorry, Victor, for taking too much of your time on this one. But anyway, so the other thing which I wanted to mention is in recognizing the potential of fintech in meeting these financial obligations of the SDGs, the United Nations Secretary General launched a global task force on digital financing of the SDGs. This was in November 2018. And the main objective of the task force is to identify practical and actionable strategies to harness the potential of financial technologies to advance SDGs. Now, in the weeks during the United Nations General Assembly, the task force will present its interim report, titled "Harnessing Digitalization," and the report will be launched at a summit event, which entitled "Good Servant, Bad Master," or "Good Servant, Poor Master," which obviously says it all. So technology, like money for that matter, can be useful tools to help people and societies achieve their goals, but also carry serious unintended and undesired consequences if allowed to dominate life in unhealthy ways. This summit will bring together the heads of states, ministers, and tech leaders to learn from each other and from the task force research to date after using technology towards SDG priorities. Now, there are a few takeaways, but I think the ones I just want to highlight is that the digital revolution offers major opportunities to accelerate financing of the SDGs, primarily by putting more control into the hands of citizens. See, this is a Copernicus turn, right? It's not so much the innovators, but it's really the citizens who should be in the driver's seat. Again, that question, what problems are we resolving? And there are solutions that have been put there, but I think as for the examples of things that can be helpful, I think I gave you the Emma Kiba story just a moment ago. And there's also another one that I think I would mention in this, before this audience, which is the ant forest in China. It is a smartphone app that lets users earn points by engaging in green behavior. So for instance, walking or taking public transportation rather than driving, turning off lights, recycling, etc. So when a player earns enough points, Ant Financial, now this is an affiliate of Alibaba, the group from China. So Ant Financial will plant a tree on that person's behalf. To date, more than 500 million players have caused more than 100 million trees to be planted. The effects of the reforestation can even be seen from space of such a simple product. And we think, well, okay, everybody's excited about planting trees and all that, but do we have a solution for that specific problem? And it turns out that there is. So you could apply the same approach to all the other problems that we have, maybe even in a very local way in your area, in your neighborhood, or even a much wider context in sort of, let's say, global world questions. So there is a lot that needs to be done. And I think the point there is that these discussions will continue, and I'm sure you'll be involved in them in particular ways. My last point, really last point, is really to talk about the ecosystem approach, which is something that we are advocating in various discussions. So to optimize the promise of FinTech, many economies are moving into developing digital economies. For instance, in Kenya, we had a digital economy blueprint, which was released in May this year, to drive Kenya in its quest towards the realization of a successful and sustainable digital economy. And this blueprint recognizes the importance of pushing a digital agenda forward. And the particular factors all play important roles towards the development of a robust digital ecosystem that serves the need of a diverse citizenry. For such an ecosystem to thrive, it is important to create an enabling regulatory environment and also develop a vibrant and sustainable support system which enhances access to funding, research, development, and others to spur innovation, and also to encourage and engage a broad range of FinTech players across the ecosystem. Finally, to support regulatory and policymakers towards the development of a digital ecosystem. So as I conclude, ladies and gentlemen, it is vital to ensure that FinTech innovations within the financial sector and our economies continue to thrive. Our task is to ensure that we provide research, enabling policies, and regulatory environments that will ensure FinTech services are offered safely and soundly. I encourage us all to cultivate a healthy skepticism that does not stifle but encourages responsible innovation. I should also remind everyone that even as good progress is noted, we still have about 2 billion people worldwide that are still excluded from financial services. There is serious work to be done, and we cannot be complacent. I look forward to the outcomes of this conference as an important addition to the knowledge base on FinTech, financial inclusion, and sustainable growth. Thank you very much for your attention.